Awesome. Well, thank you so much, David, for having me, and great to have you all with us today. One of the topics that comes up a lot, I'm Price Headley here. Founded BigTrends.com actually 25 years ago. This past week, we just had our full 25th year anniversary, and I know a lot of you have been Big Trends members over the past, so thanks for your support. But if you're new to us, welcome, because it's all about education and all about having the right philosophy for trading and investing success. And one of the things that I see a lot of option traders really gravitating towards one side or the other, what I would call kind of a black or white approach. Either go for high win rate, low profit targets, high win rate, or go for high reward and live with the low win rate. And I'm saying, why not have a hybrid? Why not create an opportunity to have a better win rate than you're used to as an options buyer and still get the potential for at least part of your trade to keep running, to turn into a higher reward trade once you can get your risk capital back in your pocket, right? So that's really kind of what I'm after, is not one or the other, but both, right? I'm saying, why should we settle for one or the other win rate or reward? Kind of a compromise in the middle to get both is really, I believe, the ideal. So we're going to walk you through that today, and I'll show you a bunch of examples on how we do this. And also, of course, feel free to pop in any questions that you want. I'll seek to get them covered towards the end of my presentation. But just a reminder, the information that I share with you in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations today. As you know, stock and options trading have large potential rewards, but they also have large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results, right? Future results will vary. Sometimes vary more than we expect to the upside or less than we expected. But risk is always out there. We're going to talk about risk today too. So we'll help you walk through every aspect of what can happen in a trade, win, lose, or draw. So, but of course, watch and check our bigtrends.com homepage for our terms of service, and you can get more information on all that. So my goal is to kind of talk about this hybrid approach, right? How you can start to get an improvement in your win rate versus being just a straight options buyer without putting partial profit targets in place. Really, we're talking about two different types of targets when we're making money, right? Enough to get your risk capital back. And then the rest, how do you let the rest run? How long do you let it run? When do you say enough on a trade? For me, it's this innovative kind of double or dual exit target on the upside that's really been crucial to not just long-term success. Like I said, 25 years in business and counting on our 26th year after last week's full 25th year celebration here, Big Trends, but also the idea that, you want to build your confidence. You want to believe in what you're trading, right? If you don't believe in what you're trading, you basically need to stop trading until you believe in something, whether it's a belief that's built off of a lot of trade experience, or whether it's just having seen enough trades winning and losing to feel comfortable with what you're doing. A big part of that belief and a big part of that maintaining your confidence also comes from being sensible with your capital allocations, not getting too high or low on any one trade coming up to say, oh, I really like this one, I'm going to load up, or oh, this one doesn't look as good, I'm going to back off. But rather being consistent in your capital allocation. Rather see you start small and build that up over time and prove to yourself that you can execute through uncertainty, through all the news, all the noise that's out there, right? So we call this strategy triple three options. And we're going to talk about several of the reasons why we call it triple three, and how we can get a trade on any afternoon on a Monday through a Thursday afternoon in the last hour of the trading day. Okay, we'll walk through why those days and why the setup to wait till the end of the day. If you don't know me, like I said, I've been trading stocks and options for 35 plus years. I caught the trading bug while I was a student at Duke University, and upon graduating from there, was an analyst and ultimately head of research in the 90s for the nation's largest options newsletter. Then started BigTrends.com, like I said, full 25 years ago, November of 99. And it's all about data. It's all about having a quantitative edge in everything that we do for all of our Big Trends clients. It's got to be a quantitative edge that makes it a system worth following. Because the idea of a system is saying, you never want to put all of your emphasis, all of your confidence, all of your capital into any one trade. You want to look at it much more as a longer term, gradual capital allocated across a lot of trades, and then let that edge play out through a larger sample of trades, right? If you don't have an edge, like if you're sitting at a table in Las Vegas playing one of their games where they have the edge, you frankly shouldn't be playing for very long. That's why they try to motivate you to play longer to get various incentives and comped whatever rooms or whatnot, because they know they're going to get their money out of you the longer you play if they have the edge. So think of yourself as if you're the house for your own trading system, you want to be letting that edge play out across a larger sample of trades and not trying to get all in on any one trade. So what is triple threat options all about? Why should you care? Well, here's an example from Apple. And this pattern is what we're looking at here. You can see obviously Apple had been rallying here. This is back in August. We'll show you some more recent ones too. But bottom line is back in August, it's rallying. We've got some different bands that we look at that are criteria to say, okay, is it making new highs? You can see that this stock is starting to make new highs. It showed us some positive momentum right before that where it's been gapping up. And so we're looking for like consecutive gaps up to go with that new high. And then when we see that, we buy at the end of the day in the last hour of the trading day. This is a daily chart, of course. And you can see, so near the end of that day, you go, hold on, that's a red candle. Why are you buying right into negative momentum? Well, our system's saying that once we've gotten that set up, it's a good time to get in, whether it's closing near the high or the low of that particular day. And I know for a lot of people that are candle followers, that is a big concern to watch for any kind of a red candle. But the philosophy here is that no one bar, no one candle makes a longer term trend, right? There's lots of noise in between, lots of retracements within an uptrend, lots of bounces within a downtrend where you have to know how to take advantage of that. So our system, when we were trading just around or just under 225 for triple the options, it said we want to buy into this option to the upside. So we want to buy a call option. The call, of course, is a right to own the stock. So when you buy a call, you're betting on the upside. The strike price here was 227.5. We're buying about 1% out of the money. Remember, it's just around 225 or just under. In that last hour of that trading day, this is back on August the 22nd. So you can see here that, okay, what do we buy for how much time? We go out to the following Friday's expiration. These are called weekly options. Every single week, if you're newer to options or haven't kept up with these trends, the weekly options for individual stocks, there's a weekly option every single Friday going out for at least the next month's worth of options contracts, if not more. So with Apple, of course, it's got even more weeks ahead where you can adjust your strategy to how many weeks out do you want to buy. You don't just have to buy to next month's options. The monthly options expire the third Friday of every month. But there's now options that fill in every single Friday with weekly choices. So we were buying the following Friday's week 5 of August expiration, which turned out to be August the 30th, back on August the 22nd. You'd think, well, that's not a lot of time. But here's the thing. You don't need a lot of time in these trades. If you can flip them quickly to get to a risk-free position, preferably in the next day or two, then you're saying, okay, now I've got the chance to continue to let the trade run once I can get to a risk-free trade. Well, the free trade concept is one I've promoted for a long time. But in the old days, like I said, 25 years of big trends in accounting, years ago, I was just promoting sell half at a double. Well, in this case, you wouldn't get the chance to double, but you do get the chance in the next day to get out at a 50% profit. Sometimes your 50% profits don't go on to get to doubles, right? So the objective is that if you sell half your contracts at a double, well, of course, that would be if you got 5 contracts in here we're assuming you invest $1,000 a trade in these examples, you can invest less or more. But we like for you to at least plan on investing 1,000 just because we're going to try to get into at least 3 contracts at a time at $3.33 or less per contract. So that means each contract controlling 100 shares. In this example, was $1.81 or times 100, $181 to control 100 shares of Apple stock. That would have cost you about 22.5 grand if you bought the stock at that point back on when we entered the calls. So you're getting massive leverage, right? 181 bucks to control $22,500 worth of stock. And so the leverage is tremendous, triple digit leverage, 100 times or more. And you say, okay, not all of them have that leverage, but This one did. And see, so the next day when it pops up, when we get to a 50% profit, instead of selling half at a double, we want to sell 2/3 of our position or more at a 50% gain. Because when you do the math, you figure out, well, if you invested $1,000, now it's up to $1,500, right? Up 50%. Well, if you take 2/3 of that 1,500 off the table, then you would take 1,000 of your 1,500 off the table, right? That's 2/3 off. That's your original risk capital of 1,000. In this example, it's a little bit less than that because we can only get 181 on 181 contract investment. We can only get 5 contracts. The 6th contract would have pushed us over 1,000. So 5 contracts, total investment of $905 in this example. So when you got 5 contracts on to sell 2/3, well, obviously you can't sell 3. That'd be only 60%. So we got to sell 4 contracts, what works out to 80% of our original position at the 50% target. So this actually guarantees you a profit, even if the remaining contract in this example went to 0, right? Because you're selling 4 of these contracts, more than $2.50, 272. So more than $1,000 in, you're getting like $1,088 out. So you see you're up already in this trade by about $180, even if the final contract goes to 0. Now, what do we do with the last contract? We give it a total. Once we can get the free trade, we basically say we want to be in for a total of 5 trading days. 1, 2, 3, 4, and 5. 5th day, we're out. Why? Because if we get in the prior week on a Monday through a Thursday, that means that we can ride it to the next week's Monday through Thursday and then go ahead and hop out after the 5 days. As you can see on day 5 is where the stock was peaking out. We get out of these in the mid-afternoon. We'll get into those rules in a little bit, but that was closer to about 232 when we got out of the stock, and we sold that option for $5. Remember, we paid $1.81. So that was 176% profit on the final piece. Usually it's a final third where possible. In this case, it's only the last 20% of our original position. But even that single contract generated about almost half of our profit on the whole trade. That last contract sold at $500, was bought for 181. It made you, as you can see, $319. All these examples are before commissions. But the point is that, hey, commissions have come down to be dramatically lower, $1 a contract or less, with no ticket charges anymore. So it's a beautiful thing. We say, okay, in this case, you took $905, made $683 in gross profit before commission. And you're going, okay, I like the sound of that in a matter of 5 trading days maximum. And of course, after the first full trading day, the next trading day in, after we got in, we're already out at a risk-free, even better than risk-free position. That's our goal. When you get to a risk-free position, folks, you now have not just the financial confidence to say I can let this ride, but psychologically you don't have that constant nagging that we all get, that tapping on our shoulder saying, aren't you afraid of letting a winner turn it back into a break even or a loser, letting your profit slip away? And look, even on day 2, after we got out, look what happened. In day 2, it actually tested back into where we got in. Guess what? At that point of that V right there, on intraday day 2, you're back to break even or even a slight loss, dare I say, and I'm not sweating it because I'm saying I'm giving it a chance over the 5 days to keep running. I don't want to get noised out of the trade. So we're saying give it the 5 days, let it run once you get your risk-free position. Now, if you don't get to that risk-free position, we're going to talk stops in a little bit, but the idea is, okay, that's where you can start to see your profits stack up. And sometimes they can dramatically blow your mind how big those gains can get in just 5 trading days right before the expiration. This is where we're dealing with the land of a lot more leverage in the final 5 to 10 days before an option expires. For a lot of people, that would scare them away. And I'm saying, look, if you're willing to take a little bit of risk, you can't lose more than you put into the trade, right? That's your absolute worst case. If we can get that money back so that you're not sweating that anymore, and then you can just let it run and see what happens, I think you're going to be really positively surprised over time how big the rest of those trades can grow to. We're going to hold it a week or less. We're just buying slightly out of the money options usually with this strategy, right? With Apple being a $225 stock, of course, we had to go a little bit out of the money to keep the option under $3 1/3 and still get that bang for our buck that we're looking for. So we're not trading them in this week's expiration. If I made a recommendation today, I don't want you in on this Friday's expiration with this. It doesn't give you enough time to let it keep running. You want to see that keep stacking and building in your favor, right? You're taking advantage of the power of compounding, the power of that leverage, multiplying many times over. We're not scalping with this approach, right? We're not trying to, what I say, and try to pick up proverbial nickels and dimes in front of the bulldozer. We want to be the ones and have you be the one riding the bulldozer for the much bigger opportunity. The other great thing about this method is it can generate up to 10 new trades a month. We're going through a focus list of names. It's not every single name in the S&P 500 that we're going to trade. It's a focus list because some of those names historically work better than others, looking back over 10 years or more. And while the past never guarantees the future, the idea is that we can find a lot of patterns that will tend to repeat over a large sample of trades. Our win rate has actually been better than 50% historically, and that doesn't sound that great. I know a lot of people get promised 80 and 90% win rates by certain services. The bottom line is that if they're targeting really small gains, maybe you can generate those high win rates, but the problem is one meaningful loser wipes out a whole bunch of your small winners. What we're after here is to say, look, a lot of times the average option buyer might be very comfortable with the win rate between 30 and 40% and still can make a lot of money because when they win so big compared to when they lose. They don't lose nearly as big. Here we're kind of creating the hybrid where we can start to boost your win rate and also still get the chance for some really meaningful gains that can be quite a bit larger than the average loss. So kind of trying to look at the both sides of the coin and benefiting from some of the features and benefits of both the higher win rate and still getting a runner on part of our performance. Now, notice we say we need to see a positive 10-year profit factor. What is a profit factor? A profit factor means we're not just looking at win rate. That's part of the equation. But another big part of the equation is how big we can win when we're right and how hopefully much smaller we can lose when we're wrong, right? A lot of people miss that part of the equation. If we were just playing coin flips and you said, well, the 50-50 and you make $100 when you're right, you lose $100 when you're wrong. And you're like, well, over time, I'm not going to make any money on that method. But if I can tell you that, well, if you play coin flips and then I tell you when you're right, you make $200, when you're wrong, you lose 100, you should be running to sign up to play that game because, of course, the odds would be stacking in your favor over a larger sample of trades with the bigger size of win to size of loss. Okay. That's what we're talking about and kind of now putting those odds into your favor as well. We don't get in on Fridays because we don't want to take it to the next Fridays, cut it so close to the expiration day. The latest we could be out would be the day before that weekly options expiration on a Thursday when the options expire the next day. So if I got in today, here we said on a Wednesday, and our trade can come out between 3:15 and 3:30 in that last 30 to 45 minutes before the end of the day. We're trying to make sure the daily chart is indeed set up correctly. We don't want to cut it too close to the close, give you enough time to get in. We send real-time emails, and you can also get mobile phone updates via WhatsApp. Once you become a subscriber, we'll send you more details about all that to make sure you never miss a trade. And never miss not just an entry, but never miss an exit. We never leave you hanging. You always know where we stand on every single trade. So it's a beautiful thing to say, okay, if we get a trade today, we know we could take it and then take it on out to the end of the day next Tuesday, and options that are going to expire next Friday, the day after Thanksgiving. And with this being Friendsgiving, it's all about strategies that can work across the holidays and across all kinds of different environments, up, down, and sideways markets combined, right? We can trade this in either direction. So the idea is that we're going to get out after the 5 full trading days. And the interesting time there is 1:30 p.m. on the 5th full trading day in the trade. We don't want to take it right to the close. We found that getting out a bit earlier, still giving it plenty of time to have run over that week. And then if they haven't hit their stop, then we're going to go ahead and give it a chance to keep running, especially when you get to that free trade approach. And so performance since inception, you go back and look, how have we done? Again, when I do these, I want to remind you, of course, that don't get stars in your eyes and say, okay, you should load up on the next trade. Any new subscriber coming in, I say, start small and know that it's scalable and that you can build up over time into even bigger allocations as you gain confidence, as you've seen what winning trades look like, and as you've seen what losing trades look like, right? I want you to see how the system works, and don't just take my word for it. Let the system prove it to you. We've got a great let the system prove it to you special for you at the end of the presentation. But you can see, going back, knowing that past performance never guarantees future results will vary going forward. you can see that we basically tripled our account on a gross basis. $5,000 account would have grown to just over $15,000 in gross value, $10,000 and plus in gross profit. That means gross before commissions and before subscription investment, right? So the idea is that that's looking back to the beginning of last year through today and all closed trades. So I love how my team's always so real-time accurate to say, yes, that's what we would have done looking backwards. Like I said, the future will vary, but what will not vary is our commitment to following the system. And so your job becomes so much simpler when you don't have to play that guessing game every day of, should I go bullish? Should I go bearish? Which option should I buy? We do that work for you. We do a lot of scanning, a lot of filtering, that whole profit factor. It takes a lot of time, frankly, and we're saving you a lot of time in addition to saving you a bunch of money to get started when we get into the great try it out special at the end. But point being that we never compounded this as well. We assumed that you were allocating up to $1,000 a trade and never growing that allocation, right? So when we doubled the portfolio or tripled it, we didn't double or triple the amount invested per trade. We just said keep it at that same $1,000 a trade and just show folks what that does. You can obviously play with your capital allocations over time to potentially get more bang for your buck. But I find that, hey, it's not a bad thing to be consistent and continue to focus on just consistent execution so you will never get too high or too low. So when we talk about the setup parameters, again, I can't give you the exact settings. That's for subscribers, but it's not a black box. When you get signed up, we'll give you all kinds of access to, including a system rules, settings and rules sheet that you'll get to know exactly what the parameters are, so you can follow along at home as well and see these as they unfold. In addition to the real-time emails we'll send you, but we look for that consecutive gaps in a given direction. So in the Apple example before, it was gapping up multiple times and telling us, okay, there's momentum in this thing, okay? Then we're looking at that price channel we just showed you with evidence that the stock has made a recent new high. Okay, and new high is again the parameter that we develop as far as how much of a look back we want. We'll give you all those settings. For bearish put trades, when we're buying a put playing the downside, we do use a moving average filter, a simple moving average that basically has to also be violated to make sure that we're not basically getting kind of caught up in just a little retracement, but rather looking for a bigger breakdown happening in that underlying stock. And in that 10-year look back of saying, okay, what's the history like over the past 10 years? Every time we got a buy signal or a sell signal in this stock, how well has it done? And it has to be not just positive, it has to be meaningfully positive to basically say that we're going to get a meaningful edge on this. And when you get signed up, you'll get the exact settings and rules to plug in and you can follow along, but you don't actually have to do anything. You don't have to do anything except for when the real-time email comes out Monday through Thursday from 3 to 3:15 or 3:30 at the latest East Wall Street time, half hour to go at the latest before the close. We're going to make sure that all you have to do is just whatever broker platform you want to use, boom, put that trade in, figure out, okay, I've got this much money I'm putting in these trade. How many contracts will this get me? And then go ahead and get that into your portfolio. And then we'll guide you at each step of the way. So we don't take those new trades on Fridays though, because we don't want to cut it too close to the expiration. We want to kind of manage that volatility. We mentioned 333 options. Part of that 333 concept is that we say, look, we're looking for an entry at $3.33 or less. Why do we do that? Because we want you to get at least 3 contracts. It means that if we recommended something at $3.33 times, that's $333 per 100 shares on each contract, times 3, that's $999. Okay, so we want to make sure you've got that kind of capital commitment to allow you to make sure you get at least 3. So when we get to the first target of 50%, you can sell those 2 out of your 3 at a bare minimum and then let the other piece keep running. We use ATR to select strikes. What does that mean? Average true range. Basically, that's a measure of the volatility of a stock from not just high to low ranges, but also including gaps. So Wells Fargo developed that, and we find it's more effective than a lot of other volatility measures to adjust to each stock's typical volatility, and thus figure out where the typical strike price opportunity is going to be best. We call it set it and forget it on our stops and targets because we know that you're busy. You want to enjoy life, not to watch screens all day, every day. And so, okay, this is something you can really put to work for you. So why do we focus on that 333? Because it gives us that 3 contracts at a bare minimum, right? And so why not buy something at a buck or half of a buck? And it's because, you know, those options are going to be more sensitive to things like time erosion on those really cheapies. And so we're trying to make sure that we can get that first target, get to that free trade, and then give it a chance to keep running. The first target is a 50% gain. So look at this example. Say we did have an option price at $3 or $300 per contract. We could buy 3 of those on $1,000 maximum investment. That's $900 invested, right? Okay, well, you get a 50% gain. Your $900 turns into $1,350. So you get that. That's, think of another way. Each of those $300 contracts turn into $450. That's 50% gained. So you sell 2 of those 3 contracts at $450 a piece. 2 times $450. There's your original $900 back in your trading account. Now you've got 1 contract left that's sitting at $450 that we're hoping will go on to a much higher multiple. But if it doesn't go on to that, we're still not sweating, right? What's the worst that can happen if the remaining contract goes to 0? If the stock tanks for some reason, goes the other direction, then basically you see in this case, you would be at a break even at your worst case scenario if that happened. So that's where the 50% profit on 2/3 or more of the position is really an ideal thing to free you up, not just financially, but psychologically. I talk to so many traders that are so bound up by having seen their past winners turn into losers, by having drunk the Kool-Aid on some name that they said, oh, this name will be good forever no matter what. Let's face it, you've always got to stay flexible. You got to stay definitely open to all kinds of possibilities in the markets. But this is why getting away from this all or nothing, black or white approach and going to a shades of gray mentality is to say, you know what? When I sell 2/3 of the 50% gain, I'm feeling a massive amount of relief, a massive amount of comfort in knowing that now I can give that trade a chance to keep going and not have to sweat it. You know, obviously, the more you can do that, the more you can open yourself up to truly letting your winners run and turn into something bigger. And if they're not going to be a winner, we've got some examples of how some of these different um, remainder pieces can shake out. Some can be winners, some can be losers, and you can still make money on the trade, right? So here's one that was not your typical home run type of name that worked out quite nicely for us on Philip Morris, PM, the tobacco giant. So here's one we see. We're getting our breakout. We've been seeing our upside gaps that we were talking about. We see this big gap and this big breakout into the end of the day, new high there. And you see that it's just about 109.5 into the close. So we're buying, in this case, a 111 strike call. This is based on, like I said, the stock's typical average true range and volatility, and saying, okay, that we believed that the slightly out of the money, about 1% out of the money, the 111 calls expiring the next Friday were a good buy. And so we bought those 111 calls. We paid 80 cents. That's $80 per each contract that controls each 100 shares, which 100 shares of stock here would cost you just under 11 grand, right? So you're controlling $11,000 worth of stock for under $100, or just $80. So you're able to get 12 contracts, $80 a piece. That's $960 invested if you're putting in a maximum of $1,000. Obviously, you can adjust if you're putting in more. But the idea is that, okay, what do we need to happen? That $80 has to turn into $120. If that happens, right, we got 12 contracts. We sell 2/3 of our position. That's 8 of our 12 out at that 120. 8 times 120. There's your $960 back on that 50% profit, which of course you can see happens here the next day. The next day, stock spikes up just over the 111 strike price that we bought. And you say, well, how is it possible to have that option be worth $1.20 when it's maybe only like 40 or 50 cents in the money above the strike? Because there is still this time premium that is in these options, right? In fact, the maximum time value of any option in the money, at the money, or out of the money, the maximum time value will be the at the money choice. So as we go from slightly out of the money to at the money, we actually see a pickup in that total time value, the dollars of time value. And therefore, it's part of why we're able to benefit from this sort of expansion in the time premium, while also getting a little bit of intrinsic value here too. So you can see here that it's going up above 111 that day. So we're selling out a half. And sometimes you look back and say, oh man, I wish I'd held the whole thing for that 325% final target profit. Wish you could have held the whole thing. Our philosophy is don't play that game of what it could have, should have. Say, look, being freed up to take your 2/3 of your position off at a 50% gain truly will open you up to allow you psychologically to not go hit the sell button, the exit, get out button, right? It'll allow you to say, back off, step away from the keyboard, sir or ma'am. The idea is that, look, give it a chance, give it the 5 days, right? You owe it to yourself and your portfolio to give it a chance to run and turn into something potentially much bigger. Think about it this way. Look at this. The last 4 contracts, right? You say, well, what can 4 contracts do? Last 4 contracts, we sold 2/3 at $1.20. The last 4 were closed at $3.40. You can see on day 5 here, stock got up to almost 115, 114.83. So therefore, the options were worth up to $3.83 intrinsically. We're out there, like you said, around the 130 point in that 5th full day of holding them at $3.40, 325% gain. But think of the dollars at work here, right? Your first 8 contracts were sold for a $40 profit a piece. That's $320 you made on the first 2/3 of your position closed out, right? Think of it that way. But look at what the last 4 contracts did. Each of those contracts went from $80 to $340 for a $260 profit per contract. 260 times 4 is $1,040 of profit on the last 4 contracts. So of the total position, the last third, you can see, made you more than 2/3 of your total profit, right? That's potent right there. You start to say, okay, you got my attention. You see why, okay, it was fine to sell part of it to get to a risk-free trade, but letting it run, giving it a chance to just keep powering ahead and seeing the institutions pour on the gas. Let's face it, the institutions are the ones driving these markets, not you and me as individual investors and traders. The institutions cannot pour all their money in at one time. They're afraid they'll splash all the water out of the pool if they all come barreling in or barreling out at once, right? So they're gradually building their exposures over time. It's one of the big reasons why I believe these trends do exist and why trends do persist. That means they last longer than you or I would expect. One of the biggest eye poppers here, look at Apple. Now, this is back in June. You recall, of course, what are the 2 letters that have been the most popular letters in the marketplace over the past 2 years? The letters AI, right? For artificial intelligence. Well, guess what Apple did? They said, yeah, we've got a new name AI and it's called Apple Intelligence. We're going to put it into our next generation of iPhones and all of our, we're getting into these other devices and whatnot with implementing AI. Well, guess what our system did? Our system said, look, stock is given that slight higher high right there. We want to buy it into that day's close, and the stock finished around 194. And we told our subscribers to our 333 option, said time to buy back on June 10th, buy the next Friday's 195 strike calls. These are the 3rd Friday of the month, which are the monthly options that are already been out there for a while. We're buying the June monthlies back there on June 10th. They're going to expire on June, in this case, the 21st, right? So we're well out before then. But the idea is that, okay, in on the 10th, bottom for 222. The very next morning, stock shooting up on this AI Apple Intelligence news, right? We're cashing out of the first piece when it's popped up here under 200, right? First half is out plus 50%. You say, oh man, look at how much money you left on the table. I don't care about leaving money on the table. I do care that we still have something left. Where you really kick yourself is if you sell the whole thing down at a 50% gain. And look at what we only had 1 contract left. We got 4 contracts in, $222 a piece, $888 total investment, maximum $1,000 commitment per trade. So you have to sell 3 of the 4, 75% of your position, up 50%, 222 to 333. Great. You made $111 a contract. But look at what the last contract does. The stock rips over those next 2 days all the way up to 220. You say, oh, you should have sold it up there. We see it settles down on days 3 and 4, but by day 5, it's rallying back up in here towards 218, 218 and a half. And we were selling out around 218 for 22.95 on that last option contract. What do we pay? $2.22. 222 to 22.9, almost $23, is a 933% gain on that last contract What can one contract do? Well, it can make you 10x your money in this example plus, or think of it in dollar terms, it made you over $2,000 on one single contract left, right? You made $2,073 on that last contract, the one lone runner contract. What can one contract do? A lot. Okay. Don't get cute and try to sell it all at a 50% gain and say, oh, I'm just too afraid of it slipping away. The whole point of this is to let the runners start carrying your portfolio. Too many people are missing out on these runner opportunities here. This is a way you can stop missing out. Those were just call trades. How about put trades? Here's a bearish example with Wells Fargo. You can see here that our setup here show that Wells Fargo was undercutting recent lows. That's a new low in Wells Fargo, right? We've seen lower opens here versus the prior day's close, and you can see that now look what's happening. We're getting into this one right near the end of the day there. Stocks trading around 43.8. We're buying, these options are cheap, right? Wells Fargo, the bank stocks, nobody expects them to move that much. You'll see an even bigger example in a little bit on Wells Fargo in the other direction. But here in this example, playing the downside, we were able to buy these 43.5 strike puts, just one strike down below the current price, about 30 cents out of the money, less than 1% of the money. We're able to buy 15 of those contracts at $65 a piece. That's $975 invested. You enter 15, you know what your first goal is, sell 2/3 of them, 10 of your 15. When it gets to a 50% gain. Hold on. What happened? It gapped down the next day. It was at 43.8. The next morning, it opens down here under 43.2. It's going into the money. Our $65 a contract is now turned into $121 a contract. So our first 2/3 of our position actually guarantees us a pretty healthy profit on the whole trade, right? We told you that you invested a total of $975. Well, 10 contracts out at $121 a piece means you're out at $1,210 on 2/3 of your position. You're already to the good by more than $200. You've guaranteed yourself a profit on the trade, even if the other 5 go to nothing. As you can see, it tried to keep going on the downside, got down to the low 42s, might have gotten up to about $1.50. But on day 5, we're getting stopped out in here, time stopped in this case, 5 days later at 1:30 on August 21st, still a few days before the expiration there of those week 4 contracts. And you can see in this case that we're out at a 75% gain, actually slightly less than what we closed the first 2/3 out. The total profit was $805 as a whole, about an 80% gain on that $975 invested. So the beauty of that is that we gave it a chance. It didn't keep going, but hey, it didn't hurt us either. Still made a healthy gain for a week's work. So the whole principle of this system is target 50% on your first target and get 2/3 of your contracts or sometimes more out to get that trade to a risk-free free trade status. Now, sometimes there could even be a loss in the final third, but that trade could still generate a profit when you've gotten the first chunk out at your first target, right? So here's AMD, Advanced Micro Devices, the chip stock leader. You can see here that we've got the July monthly 185 strike calls. We've seen a big breakout, right? We've seen this higher momentum. We're not early here by any means, and yet stock's about 178 and change. We're buying the 185 strike calls. These are not cheap options going to the next Friday's expiration. This was actually happening kind of at the end of a day, Monday, going to the next Friday. We're buying a little more time than usual. It's part of why we had to go a little further out in our strike price choice to 185 strike. And you say, oh, that means it's got to get over 185. Well, not necessarily, but you can see in this case that we paid $325 for each of those contracts. We can get 3 of those with $1,000 invested, $325 a piece. That's $975 total, right? Well, you get 3 in. Now you're trying to sell 2 of them when it gets to a 50% gain. So that 3.25 turns into 488 and makes us 50.15%. So you're out of 2 contracts of the 3, and now you're sitting on 1 more contract that you're hoping is going to keep going. But that was day 2 where we cashed in at the 50% gain there. But by day 5, you see what's happening. It's starting to lose momentum. But we still have some time left, thankfully, in the trade that allows us to salvage some value here. And really, a lot of times it's when you sell half or I'm sorry, 2/3 of your position to get to the free trade. A lot of times what's left on the final contract is often, or contract is going to be your basically your profit, right? So we're out of the first 2/3 at 488. As you can see, the last contract sold at just 239 because it did not keep going. It started to reverse on us. And so we ended up taking a 26.5% loss on the last contract compared to what we got in at, but still made $240 overall on the combined position. So it still was a profitable trade. It makes us about 25% as a whole. And we're saying, okay, we're not complaining. We hoped it would keep going, but if that hope is not a strategy, right? This gives you a clear-cut way to trade these and help to guide you. If we can't get out exactly 2/3 of the position, we will round up to take off more than 2/3. So like here's a case with Microsoft where we bought in at 250 a piece on these 430 calls, right? It was looking like it was headed to the races. We're buying into this little retracement here near 428. We're buying slightly out of the money 430 calls in the following Friday. And those calls cost $2.50 a piece. So we can get 4 contracts. Well, of course, you can't sell 2, that's only half. So you sell 3, that's 75% of your original position at the 50% gain. Of course, thus you're assuring yourself a little bit of a gain, even if the other contract goes to nothing, which is about what happens here, right? You can see that with 3 contracts out at 375 a piece means you're getting a total of, as you can see here, that works out to what works us out to not quite $1,200 here, but like $1,125. We're in for $1,000. You're up $125. The final contract, look what happens on the final day in this trade. Final time stop. Oh, it's gone the other direction and really slammed us down. We only got 10 lousy bucks, 10 cents, these $10 on the final contract exit. 96% loss on the last contract, and yet we still made $135 gross on the trade. Not anything to shout about, but saying, look, the buy and holder that's out there buying and hoping is set up for big problems ahead if they don't take that first target profit, right? So this is what smoothing out some of that risk, some of that volatility will do for you, is it'll give you that opportunity to say, okay, we sold 2/3, in this case, slightly more, 50% gain, have an assured profit. The other side tanks, and we're still making a touch of money. Now, stops. Not every trade is going to win. What do we do with stops? Our rule is we don't want it to go past about a 50% loss. So we put a stop in at a 50% give back. It's possible you can get a little more slippage, a little bit of a fill below 50%. In this case, we were trying to get out at 19 cents if it traded there. When that traded there, it actually triggers out, and we got filled at an average of an 18-cent exit versus our 38-cent entry. This is a cheap option, right? Bank America 43 strike calls. We're playing for the breakout. We get a little bit of extension, but then it's that flip down the other direction on day 3 that stops us at our 50% stop loss. So down in this case, $520, 26 contracts down $20 a piece, $520 before commission, right? So the idea of all this is that it will happen sometimes that it doesn't fire. Don't panic if that happens. It's saying, look, if it hits the stop, you just exit it, salvage what you can, go on back to the sidelines, wait for your next trade, right? We don't hold and hope. If it hits a 50% loss, we're done with the trade. So, but the key here is that the running piece, the last piece of your trade that's allowed to run without a stop loss, without a final profit target, can result in some massive gains. Here's a Wells Fargo call trade to the upside. Look at how extreme this one was, right? A lot of people think you got to do this on tech stocks, but the problem with tech stocks is that you're paying for that privilege, right? You're going to pay up with a tech stock call or put versus a bank stock like Wells Fargo. Nobody expects it to move. So you can see Wells Fargo starts to trigger here for us. We get our signal in the last half hour of the trading day back on December 7th. And you can see the stock's trading about just over 43, maybe 43 and a quarter. I'm sorry, 45 and a quarter. We're buying slightly out of the money, next strike out of the money, 45 and a half strike calls. Those are trading. That was on a 12/7. You know, you can see that it's on a Thursday. We're going to the next Friday's expiration. We pay 59 cents a piece. $59 times 16 gets us in for something just under $950. Well, you can see here that We're getting in there on the 16. So we've got to sell 11 of those 16 when it gets to our first target of 50%, which happens the very next day. It's just, you can see the stock shoots up from just out of the money to slightly in the money, even almost a half point in the money at the highs up here, closer to 46 and a quarter, 46 and a half. So we sell out of those first just over 2/3 at $89 a contract. That's $30 a contract on 11 of those. That's a $330 gain so far on the trade. We still have 5 contracts left after our first 50% target is reached that next day. You can see day 2, it kind of pauses in here. Day 3, it starts to perk up. Day 4, it starts to really lift. And then look at day 5. In the afternoon on day 5, it's up here pushing over $50, right? Remember, it started out at around 45 and a quarter. So this is a 10% move in Wells Fargo in 5 trading days. That's huge. That's almost unheard of. And thus we're getting out of those options that were bought for 59 cents a piece, exiting out of them here at the $4.85 exit. So when you see things like that, you say, okay, that's the kind of stuff that we can really get a lot of traction off of, a lot of interest, a lot of momentum behind, to say, yeah, once you had taken that first piece off and you saw it pause for a day or two after, you should not get cold feet. You should give it a chance to keep running. The runners are where we get paid some of the best returns relative to those that are just looking to hit it in, hit it out, hop in, hop out real quick. We're trying to let it run on at least part of our position once we get that risk capital back. So we send our 333 option subscribers real-time trade alerts, so you know exactly where to get in, exactly where to get out. You're never left hanging. You get them through a real-time email. You also can get them as a real-time update to your mobile device via the WhatsApp technology. So when the strategy triggers a fresh signal, let's show you how you can get these. We'll come back in and reinforce some of the frequently asked questions too, and then pick out some of yours here in just a little bit too. But, 3 months of the service, because I want to give you a chance to try it out. I want you to not just take my word for it. I want you to say, sure, 25 years in business, that's great. But I want to say, let's focus on how you can let the system prove it to you. I don't think a month is enough. I think 3 months is more than appropriate to say, look, try it for the next 3 months. If you're buying it off of my website, you'd pay a lot more than what I'm going to offer to you here. So you're going to get a lot of other goodies here, a lot of other educational bonuses. We call it a learn while you earn strategy here. I get you my settings and rule sheet. I just ask on all these that you use it for your own benefit and your family's benefit, and do not share this on the outside or on any web pages or anything with anybody else. That's part of our terms of service. It's for your benefit when you become a subscriber to take advantage of the system. But the point is that let's keep it that way. Bottom line is that, okay, weekly video training. I do it every single Monday. I pop a new video in saying, okay, here's what happened this past week. Here's what worked. Here's what didn't. Here's what we're doing next. Whenever you've got a question, which, hey, we got a lot of subscribers with a lot of questions. They're getting set up. You're trying to figure things out. If you've got a question, we've got our analyst team and myself that stand by to a dedicated email address. Say, if you've got a question, pop it through that address we send you, and know that we are committed to making sure that you're going to have a lot of success with this program. So, but that support element is so vital. Now, at a $297 a month list price, multiply that times 3, and that's just under $900. It's $891 total value. But the special package I've just approved for you today allows you to take advantage of these 3 months of trade alerts. Also allows you to get the 3 trading resources as a nice free bonus there. And then the retail value of $891, we're taking it all the way down here to just $197. So where do you go to get it? You go to this page here. It's members.bigtrends.com/friends. It's part of Friendsgiving. Thank you, David, for being a longtime friend. And of course, appreciate all of you for your friendship, support of Big Trends. But also, we look forward to working with you over the course of these 3 months to show you how the system can benefit you, how you can position for a lot of different moves to come, both to the upside and to the downside. So when you go to that page, we're going to go to that in a minute. We'll show you what you do. It's real simple as an order page, or a nice secure order page there. Some of the common questions we get: what type of strategy are we doing here? The simplest option strategy, in my view: buying a call or buying a put. Guess what we do when it's time to get out? We exit or sell that call or sell that put. We don't put on a new position. We don't try to scale in or out of any new kind of like legs. We basically are just managing the one leg we've got with the two different profit targets or the one existing stop. What are the recommended prices of a 333 options or T30 service trade going to be? Always at least or less than $3.33 per contract. Why? Because multiply times 100s and each contract controls 100 shares. That means every contract should not cost you more than $333 a piece. That means if you're putting $1,000 in to try it out or trade, then you're in a position to say, okay, it's in at 333. That means I've invested $999 on 3 contracts. When I can turn that $999 into a 50% gain, I'll sell 2 of my 3, right? We want you to have that ability to get out of 2/3 of your position or better and take full advantage of that. Now, when are these new 333 options trades sent? They're sent in the afternoon on a Monday through a Thursday. So we could have a new trade for you today between 3 o'clock Eastern and 3:30 p.m. Eastern. We never force trades. We're always focused first and foremost on making sure that it's the right trade, the right setup, the right history behind it. Everything's all systems go through the entire checklist process that we go through. Just like if you were flying an airplane, you want to know your pilot's gone through the full checklist. Say, yes, this plane is ready to take off. If there's a problem, we're not leaving we're not taking off until we've made sure everything's checked off. Will you have any day trades with this system? There are 0 day trades with the system because since we're getting in so close to the end of the day, the earliest we could see our first 50% profit target hit would be the next morning. So that's what we're after there and not worrying about day trades. How do you get the trade alerts? We send them out through real-time email updates to your preferred email address, but then we'll also send you instructions on how you can use WhatsApp on your mobile phone once you become a subscriber to actually set that up so you can get alerts sent to you through the WhatsApp technology on your mobile device. How many trades do we get per month? Up to 10 new trades per month. We don't want to guarantee that every month. It's possible some months could have 6, 7, 8 trades in a month, but typically we expect to get some pretty healthy volume and over the course of a year do about 100 trades a year, give or take, at a minimum. And so you look at a maximum number of open positions when you're thinking about how you're going to allocate your capital. We will not hold more than 4 trades open at once. If we've got a new idea, something else is going to get closed out to make sure we never exceed the 4 open trades at once rule. When do we get out of the trades with the time stop? Once we've gotten the first 50% profit target, we give it the full 5 trading days to allow ourselves to let that trade keep running. Some of them will keep running, some of them won't. But the idea is to let that recent breakout continue to play in your favor over time. So that's really important to us to make sure that you're not going to get too high or too low, that you're not going to essentially put yourself in a position where you're going to not be following the rules of the capital allocation or following the rules of the system entries and exits. And so look for that guidance from us to help guide you as well. So like we said, when you think about, how you can get started here, you go to this link here. It's members.bigtrends.com/friends. Okay. So members.bigtrends.com is not a www link. It's a members.bigtrends.com. That's actually your member site access link to get to Big Trends. You'll get a dedicated, when you get signed up, you get a dedicated email to help you take advantage of this. But what we've done here is we've made it super, super attractive for you. So think about this. We're thinking, okay, look, over the last less than 2 years, turned a $5,000 account into more than $15,000 for a $10,000 plus gross profit. Gross, that means before commissions, before subscription investment. And we never compounded our amount allocated per trade. We just kept it at the fixed $1,000 a trade, never more than that. We all know past performance never guarantees future results. Future results will vary, but what will not vary is our commitment to helping you consistently follow these signals. So like I said, your price here, when you lock it in today, is part of the Friendsgiving special, which again, I really appreciate David and the team allowing me to join in, share with you what's worked for us through all kinds of market conditions. That price is only available at this link here. If you go to my website, you'll see you can't get that you can't get that lower price by far. You'd pay more than that for a month. well over it. So the point is, look, think about it this way too. You're getting the next 3 months. That's the next 90 days, which means your price per day, your outlay per day is less than $2 a day to get trades that have the potential to make you potentially thousands on any one trade. It can, like we showed you with Apple, we showed you with Wells Fargo, trades that were turning into, more than a couple $1,000s of profit on just one trade. I can't guarantee which one's going to be the next. You've got to be disciplined and follow the system. But what you can see is that for $177 for 90 days worth of access, you should see plenty of opportunities. And of course, know that when it's not working, we'll help you manage your risk too. We never leave you hanging. So what that order page looks like when you go to it, it's really clean and really simple. So I want to show it to you here. We're all about the KISS principle, keeping it as simple as possible, right? It has really served me well in my 35 years of trading and counting. And so you can see what we're doing here is we're saying, look, we want to already take into account these discounts for you. We don't want to make you do any other work. So no promo code discount applies because I've already taken that $891 list price down by more than $700, dropped it down for the next 3 months access for just $177. That's the next 90 days. That's going to take you, as you know, through not just through the December holidays, but then through January and into the second half of February, right? So the point is that from now till February the 19th or so, you're going to be able to access this, see the system and work, see it, and then ultimately, I believe you're going to want to continue, right? And when you do, no, you can call us. This is not an auto bill, mind you. It's just a one-time investment. We just want you to try it with no further obligation. It's only $177 for the next 90 days access. Call our 800 Big Trends number. That's 800-244-8736. Or to reach my customer service and client care team, you can just email clientcare@bigtrends.com. So all you do there is, that's a secure page. Like I said, now our 26th year doing business, just had our full 25th year anniversary this past week. Payment info there. You can get your credit card info in. Make sure you get your email info in over here correctly, because of course that's going to be the first way we communicate with you. We will also send you instructions about how you can set it up for mobile phone access on your alerts as well. But as you scroll down the page, it's not just that page that you can put your order in. You can use PayPal. So you just click the agree to terms and conditions, which are hyperlinked there and down below as well. And then click the PayPal link. That's how I do a lot of my online purchases. Click PayPal, log into your PayPal, choose your money source, boom, boom, boom. A few clicks later, you've locked in 3 months of value that would have cost you over $800, almost $900. You've locked it in for just $177. Like I said, over 90 days access. Over the next 90 days access, that's less than $2 per day is your outlay. What's that? A half cup of coffee at Starbucks. But basically, the idea is we want you to get maximum bang for your buck. We want you to keep most of your money working for you in your trading account, so you can prove it to yourself and prove it that, yes, you like this. Yes, you want to stay with it. And then you can call us as the 90 days are ending and say, how do I get a longer term subscription? Right. That's how we've been in business 25 years and counting, because we're big believers that we've got to prove it to you each and every day that we're doing our very best to work hard for you, to find new opportunities, to keep you out of trouble when it's not time to trade, right? We're not in the activity game. We want to help you generate results. We want to help you generate also a lot more education and knowledge about the strategy and about options trading in general and smarter ways to go. So we are big believers in constant education. That's why you get the weekly video training to go with the settings and rules sheet. It's not a black box system. You're getting all of this access for just $177. Why would I sell it so cheaply? Because I've found that people love getting great value for their money. They tell their friends, they come back, they buy more stuff. I think you'll want to do the same. Like I said, 25 years and counting, it's worked well for Big Trends, and I think it'll work well for you too. So it's a team effort here. Okay. We look forward to working with you across this. Let me see if we've had any other questions. Let me remind you too, by the way, where do you go? What's the link again? It's there at the bottom of the page. I'm sure David has posted there in your Zoom chat box. It's not a www link. So that's an important note there. It's a members.bigtrends.com. So that'll be your member site access to get access to your recordings, get access to your settings and rule sheet, etc. But members.bigtrends.com /friends as part of this Friendsgiving celebration this week. Thanks again, David and team, for including us as part of your friends to share what's worked for us and a lot of Big Trend subscribers. So go there now, folks, members.bigtrends.com/friends. I think that might be all of my slides. It is. So I want to see if maybe David has any questions for me off the chat before we get ready to hand it over to our next trader.
Someone asked about the overall win rate. I think you answered that earlier, but if you want to talk more about that.
Yeah, thanks, David. Yeah, I mean, typically if you're buying options, you expect a win rate less than 50%. You expect a win rate probably, frankly, closer to 40%, maybe even closer to a third. And we're looking at win rates over 50% because of the times that we're able to book the profit and get to a risk-free position quicker at the first target of a 50% gain, selling 2/3 of your position. So that has boosted our win rate from those 30 to 40% ranges up to over 50% winners. And if you think, oh, that's terrible, I'm looking for 80 or 90% winners, well, then obviously you can get that too. We have strategies that do high win rates, but they don't give you this kind of upside, right? They might generate 20 or 25% gains per trade, not trades that can turn into, like I said, you invest less than 1,000, you possibly make more than 2,000. We showed you some triplers plus in past examples like Apple and Wells Fargo and more in today's presentation. So to get both, remember, that's what we're doing here, the hybrid. Get a better win rate than you're used to as an option buyer. 50% plus win rates are objective. And then also to get more big winners because you're keeping part of your trade on. What I have found in my 35 years of trading and 25 years in full since launching Big Trends back in late 99 is that when you're right, you probably found this too, by the way, folks. Tell me if you can relate to this. When you're right, you tend to be right longer than you would expect. And when you're wrong, you tend to be wrong longer than you would expect, right? It's rare that bad ideas turn into great ideas, but it's a lot more common that starting off with a good idea with a 50% gain can get further validation and turn into something bigger. Like I said, it doesn't always keep going. Sometimes it reverses. That's why we sell part of it to get to the risk-free trade. But giving yourself a chance to keep running, right? Too many of you are not giving yourself a chance for the running bigger profit. They're just saying, hey, they say bulls and bears get rich and hogs get slaughtered. I don't want to be piggish, nor do I. But by getting that risk back off the table, getting all of your risk capital back into your account in the safety of cash, and still having a third or sometimes even 20% or 25% of our original position on, and having that runner that can turn into something much bigger, that's an aha light bulb moment. It was for me when my team pointed out to me, hey, you like selling half at a double? Well, look what we can do when we sell even faster at a 50% gain, how many more trades we can get, how many more opportunities, and how many more times we can have our clients and us be that much happier that we're already at a risk-free position and taking the stress down even more dramatically in your trading and leaving on something to truly get the big payoff. That it's not going to happen every time, but when it does, boy, it can carry you a long way. And I believe you'll be really pleased with this. So that's the